Hi, I'm in Toronto today. Thought I'd talk for a moment about financial services and finance. I've ended up specializing somewhat in finance in the last number of years in financial services because financial services companies have the largest amount of finance data. Funny how that would be. Financial services includes capital markets, banking, and insurance as major categories. If you think about the original records, the original systems for these organizations that would have started in the earliest days as a simple general ledger. A customer account was the same thing as a general ledger account. Customers had their own special account that was part of the GL. Over time, as the organizations opened new branches for their businesses, they would create new ledger books within those branches. And those ledger books would contain particular customer accounts for that branch. There would have to be some runner of some sort that would take an aggregated balance of activity for the day for that branch and run it to the home office, and the home office would have a single ledger that posted the aggregated balance for each one of the branches together so that they could keep track of the firm balances and whole. But individual customer balances were maintained in branches. Then we started making new different kinds of products, and these different kinds of products required a couple of different kinds of attributes that you wanted to store with the balances for that customer. Loans would be slightly different from deposits, for instance. Then there started to be different kinds of loans and different kinds of deposits. Each one of these created the need for a new ledger book that had the attributes that were attributable to that particular kind of product. In this way, we ended up with posting processes in all of these subsidiary ledgers for all of the different products that exist in financial services. Same thing we've talked about with the advent of the ERP system and the basis of all of the business processes having posting at the bottom of them. This process of posting was never scaled. Posting was individualized to the individual subledger, the individual products. What we're seeing happen, though, is that the amount of information is lost as we aggregate and summarize to higher and higher levels. And like we've talked about traceability, the ability to understand why a balance is a balance requires drilling back down to details in lower levels till you might have to get back to the individual business events. Doing so from the home office down to a branch office in a subsidiary ledger for a particular product would be very difficult to do. Doing that for a customer that had commercial loans and deposits of one type or another, and perhaps wanted to do banking in multiple branches, all of that complicated the ability to understand the true vision of why the balances were the balances, because traceability was highly impeded by the breaking up of these processes in such various ways. But it was efficient for processing purposes because the transactions were summarized into balances easily and were maintained in a very efficient manner. Getting to the balance for an individual product, for an individual customer in an individual branch was not difficult. Where we are going today, though, where we need to go, is we have to use our information much more effectively in understanding all of these different kinds of attributes and different cuts of data. And these individualized posting processes broken up into these subsidiary ledgers distributed throughout the organization is an impediment for us to be able to do that. So our need is to create a system whereby we have greater access to the detail and more consistency across the organization that allows us to create the cuts and slices and dices of the data that are required by today's modern organizations.